Good day. Welcome to Asset TV Boutiques Connect. I am Zama Zulu, and for this session, I am joined by Imtiaz Suliman, who is a portfolio manager at Sentio Capital Management. Greetings.
Thank you, Zama.
Nice to see you, Imtiaz.
It's a pleasure to be here.
Especially seeing you in the Cape for a change. I always see you in Joburg.
Yeah, it's always lovely to be down at the side of the world and looking forward to our conversation.
Great. So for this session, we are going to talk all things global allocations in particular. And I thought let's just kick off with your views as Sentio, because you currently don't have dedicated or standalone global portfolios, but you have been managing global assets for over a decade in your multi-asset funds. How do you believe your global investment approach is differentiated as Sentio?
Yeah, thanks, Emma. I think what we have at Sentio is always a very integrated approach to investing. And whether that's integration between fundamentals and quantitative investing, or between the fixed income process and the equity process, or between micro and macro analysis. It's all about integration and making sure that the different views permeate throughout the portfolio. So for example, when we talk about quantitative investing, it's not something that's a standalone process. It's always how does it complement the fundamental process. And that enables us to make better, faster investment decisions, especially in the world of global investing. You've got a massive universe that one is able to invest in, and you need to process a lot of data and integrate that into the fundamental analysis. And by the use of technology, it makes us stronger, faster, and also to make better objective investment decisions.
All right. And when you're talking about technology, are you referring to the machine learning aspect? Because that is what Sentio has become well known for.
Yeah, definitely. We've been using machine learning in our process since the inception of Sentio, which was in 2007. Although over the years it's become much more sophisticated, especially with the advent of more data being available. That's made the process much more robust, and we've been using different elements and different sources of data to make sure that we have a very robust and comprehensive set of data to make those investment decisions. So what we're seeing now is we're using a lot more of that machine learning technique to enable us to make higher conviction bets in the portfolio. And that is certainly complemented by the fundamental bottom-up process. And we're at the core of fundamental investment manager, whereby the machine learning and AI process comes in, is making sure that the conviction levels are sufficiently reflected in the portfolio.
All right, so in terms of Regulation 20 compliant portfolios specifically, you're now allowed to have up to 45% in global assets. Where are your multi-asset portfolios at the moment in terms of global allocations?
So we've been ratcheting up our allocation towards global assets as we've seen the opportunity set present itself. Our strategic asset allocation in a normal typical balance fund would be around 40%, and we found that that level is the right level in terms of meeting the objectives of the fund. We will tilt around that 40% level from time to time depending on the returns available. Currently we're just slightly over 40% because we see lots of opportunity from a global perspective. And the maximum is 45. We are able to use some derivative and hedging instruments, and that's very important, especially when it comes to global, because we always think that the rand is a depreciating currency, but there are times when it does appreciate, and it does appreciate quite strongly. And for someone that is retiring in South Africa, they have rand-based liabilities. That currency volatility can affect the overall capital values quite significantly. So the use of derivatives and hedging instruments in that instance is very important to make sure that you don't suffer from those huge periods of rand appreciation. But typically, we would be towards the higher allocation of our strategic asset allocation of 40%, given the global universe. There's so many different, uncorrelated bets that one can find from a global setting that makes the portfolio much more robust, and you can really find some gems from a global perspective.
Okay, so let's just maybe unpack that global allocation. So you say 40% at the moment. In terms of exposure to equities, bonds, cash, even global property, how does that build up?
Yeah, so currently from an overall equity allocation, both local and global, we are slightly positive towards equity, and within that we are more positive towards global equity relative to local equity. And again, that's because of the opportunity set, and what we're finding is that there's a lot of quality growth stocks from a global perspective that are showing significant value, and we find that they are anchors for the portfolio in terms of the portfolio construction process. On a fixed income level, we are slightly overweight local duration but underweight global duration, and we think global bonds are slightly expensive at the moment. And then from a property perspective, we've preferred local property over global property. We think some of the local property counters are giving you attractive yields of around 10-11% with some capital growth and less risk. There's quite a bit of risk around commercial real estate globally. And then lastly, from a cash position, we are slightly underweight cash, and essentially cash is a funding mechanism for the different overweights that we have in equities, for example.
Okay. And then just in terms of global equity specifically, any particular regions that you favor and others that you don't?
Yeah, so globally we've had an overweight towards the US generally. We've seen that it does complement the local portfolio very well, because what the US gives you in terms of the local exposure is that locally South Africa is an emerging market essentially. We're quite resource heavy, and what you gain from an allocation towards a developed market like the US is some quality growth counters that builds and makes the portfolio very robust, and it centers the portfolio. So you've got this anchor satellite approach, and what we've seen is if you look at it globally, a lot of the shares and counters that have done well are those that are listed in the US. And we can talk about some of the macroeconomic situation that's led to that, but essentially the US economy has been very robust, especially since the COVID pandemic, and you've seen a lot of companies, especially the tech sector, do particularly well, whilst some of the other regions have lagged. For example, Europe's been a laggard, China has its own specific problems, and what we're seeing now is sort of a broadening of the equity performance outside of the Magnificent Seven in the US, and that's giving us an opportunity to pick some of the smaller and mid-cap counters that are doing particularly well from a strong US economy.
Thanks for sharing your insights, Imtiaz. I must say it's actually quite an interesting time. I mean, everybody's having a closer look at what the US Federal Reserve Bank is likely to do in terms of cutting interest rates. There have been talks about that since late last year. Still nothing. You've rightly said, the American equity market has also been on the rise. No signs of slowing down. So it'll be interesting to see how the year actually eventually ends. But thank you so much for your contribution and sharing your insights.
Thank you so much.